Okay, we have a fabulous episode of Bank Nerd Corner. We are not joined, as we normally are, by Kiah Haslett. Instead, we are joined by Jason Henrichs, CEO of Alloy Labs, one of the hosts of the Great Breaking Banks podcast, and a very dear bank and fintech friend of mine. Jason and I spend a lot of time offline ranting about different things happening in banking and fintech. And occasionally we like to turn those rants into podcasts. So I asked him to co-host this week's edition of Bank Nerd Corner with me. And it is mostly rants, a little light on analysis maybe, but a little heavier on emotion. We talk about the role that VCs play in the fintech ecosystem and the level of accountability that needs to exist with VCs. We talk about the subversion of financial services infrastructure and the implications that has on trust. We talk about deregulation and the things that undermine deregulation. We get into a lot of it. And by the way, we also finish the podcast a little quicker than I normally do with Kiah. So we have a shorter but very action-packed episode for you today featuring Jason Henrichs. Before I let you get into that, I did want to mention that by the time you are listening to this, the Fintech Takes network, our professional networking platform that we built for fintech nerds, is open for anyone to apply to. So if you have any friends or colleagues who you'd like to direct to the network, if you yourself have not yet applied, I would strongly encourage you to do it. We built it as a better version of what I think a lot of us signed up for when we were going to LinkedIn or Twitter or when we spend time in various Slack groups. This is a for-purpose, custom-built platform to indulge the curiosity of fintech nerds and hopefully help us all find opportunities and answers. So far, the experience has been great, and I'd love your help in building it. If you want to apply to be a member, you can go to network.fintechtakes.com. You can apply to become a member. The other thing I wanted to mention real fast is that I will actually be getting back out on the road. It's been kind of a quiet April for me, but on April 28th through the 30th, I will be in Nashville. Speaking of Jason Henrichs, I'm actually going to be going down for an Alloy Labs event in Nashville. But if you will be at that event, or if you're just in Nashville and want to say hi in person, please let me know. I am currently in the process of scheduling my trip. So would love to see some friendly faces. And until then, I will drop you right into Bank Nerd Corner with special guest host Jason Henrichs. The Fintech Takes podcast is also brought to you by Paddle. Need more revenue, more growth, more time? Over 5,000 digital businesses trust Paddle as their merchant of record, or MOR. Unlock more revenue, more growth, and more time. Get more at paddle.com. All right. Well, we are joined by the legend, the man himself, Jason Henrichs, CEO of Alloy Labs, one of the hosts of the Breaking Banks podcast, a returning guest to the Fintech Takes podcast. Although, Jason, you are now joining your first ever Bank Nerd Corner. Welcome.
Well, I'm a little nervous because Kiah rolls in with this great depth of knowledge and well-researched and everything else. And I'm like, I can't compete with that.
You can't. And the thing that's nice about you is that you can't compete with Kiah. I know you can't compete with Kiah. And so instead of forcing you to try, which would just not go well, what we're going to do is slightly modify our approach for Bank Nerd Corner. For listeners who have heard us, Kiah and I talk bank nerd topics before, what you'll know is we normally spend most of it on, as Jason said, well-researched, relatively sober analysis, talking about different news stories or things that are happening in the banking world. And then at the end, we sort of give ourselves a little space to rant. And normally I give Kiah the honor of ranting about some subject that's bothering her, but that's like the very
and it's normally some esoteric thing that like I need to go research and be like, what is that she's so hot and bothered about?
Trust me, I know. Yeah, it's like structure of call reports, that kind of stuff is typically the subject of the rants. What we're going to do is we're going to take the small rant portion at the end of Bank Nerd Corner and we're going to make it the whole Bank Nerd Corner for this episode. This is essentially the podcast equivalent of that old joke, why don't they just make the airplane out of the same stuff they make the black box out of? This is us for rants on a podcast. We're just going to make the whole plane out of the black box material. These rants are going to be so hot that they will outlive all of the other podcast takes you've ever had. Mr. Henrichs, are you ready to just get some therapy and get some stuff off your shoulders?
Oh, let's get it out. And I have to say, last time you had me on the Fuck Around and Find Out episode, right, where I was super fired up, I was scheduled to give an internal talk for a regulator the next week. And I get a call from the point of contact. I'm like, oh gosh, I got fired. I could, I knew this was bad. And goes, well, actually, it's making the rounds within the agency. And they actually asked if you could do an extra 40 minutes of Q&A as a result of it. So I think the rants are worth something.
Okay, well, that is good to know. That's very validating for me because I had a lot of fun in that episode. And I feel like you and I thrive when we just get to bounce rants back and forth like playing tennis. So I'm going to give you the honor of serving. So why don't you go first and serve us up your first rant?
I want to talk about trust, not just my trust issues, but trust and motivations. And we talked a little bit about this in the FAFO episode, and it keeps surfacing. And I want to pick on this idea of either ignorance is an excuse for lack of compliance or for bad behaviors, or on the investor side, and especially want to pick on some of the VC pieces of this, where they act like they don't have a responsibility. And part of this is, run into this repeatedly, VCs will take board seats as if it's some kind of prize, right? Yeah. Like there's a trophy. But there's a real responsibility when you're taking a board seat. You don't just represent your fund. You actually have a fiduciary obligation to all shareholders. And I think part of the problem, and what I would love to see, I think could fix some of the issues that we see endemic in the industry, is if they actually had to take a pledge and were held accountable to all stakeholders, not just shareholders. And that would include people that may be impacted by either, untrue claims about how it's going to impact your credit score. You can insert your rant right here. I'll pause, let you get it off your chest.
Credit builders are bad. That's my rant. I'll stop there.
Okay. All right. Or when they're pushing the wrong motivations, right? Like the growth at all costs. And, I think people agree that, move fast and break things era is over, except we're not, the pendulum hasn't swung back to where it needs to be, right? When you have players like Yadis involved in the Synapse evolved tobacco going, we never expected that this could happen. Well, when you work in financial services, your job is to expect that bad things can happen. Like that is the job. And I'm sorry if that is unfair, that you don't like that. Go start a company that does something else, right? Like it is financial services and the medical field where real harm can be done. And I think that if some of these startups had to really operate in the same kind of set of rules that the banks do, and if the banks took it as seriously as they need to when they get into banking as a service with these partnerships, you would really see better for consumers, better for even business customers, because the asymmetry is real, right? Those VCs like to call it regulatory arbitrage, which is really just a fancy word for saying we found a loophole, or we don't think we're going to get caught, or we'll do it at scale. So I think at a minimum, VCs that talk about how they can add value to a startup, they really need to come in. They need knowledge, at a minimum, understand the basic regulatory frameworks. I was doing due diligence several years ago for a top firm, and we were talking about UDAB versus ACOA. They had no idea what those terms meant. And all I can think about is it's like claiming to be you're a baseball expert, but you don't know what the strike zone is. Right. And the second is that piece I hit on governance, that these board seats, they're not to represent just your fund's interests. You actually owe an obligation to all shareholders, including if you do non-compliant things that could get the company shut down. That is bad for other shareholders. And I said, I think it should extend all the way to stakeholders. And I don't think this is going to kill innovation, right? I think that's a false choice. Look at some of the really successful fintechs like, Plaid, Stripe. They understand what they're doing, has financial implications for their customers. They took data privacy very seriously from the outset. They took money transmission laws very seriously. And guess what? I think they're still pretty successful.
That was a very good rant. So just a quick response to that one. I completely agree, not surprisingly. And I think that, I'm glad you brought up the VCs and the board seats, right? Because that's the part of a lot of these sort of fintech debacles that never quite circles all the way back, right? And so it's like, the Synapse melts to the ground. And like a question that I would love to know the answer to, but apparently I'm never going to get the answer to is, what were the discussions like for the board of Synapse and its investors before all of that happened? Like, what were they talking about? What were they raising concerns about or not raising concerns about? I literally have not heard anything about any of those discussions, any of the people who claim to be in a position of governance over Synapse before it melted to the ground. It's quite frankly insane that those investors don't have to explain or even speak at all about their role in overseeing that company, even though, to your point about stakeholders, it had a massive effect on the employees of that company, the employees of all of the partner companies that worked with Synapse, and obviously, most importantly, the end customers who were impacted and who still haven't gotten their money back. So I think that's a really good example. Another one that occurred to me that I thought was just, I'd never even thought to ask this question until now, but like, what were the investors in Frank, the sort of fintech company that JPMorgan Chase bought under sort of false pretenses? I have not heard anything about those investors in that company, but it is kind of an interesting one because presumably they would at least have had some insight into the fact that, wow, I can't believe that Chase is buying this company for this amount of money. What a great outcome. Probably this is the only way that we're going to see a positive return on our investment. It's strange that Chase is just signing up to buy it, even though we really don't have that many customers. Like, I haven't seen any acknowledgement on the investor side of that story. It's all being hung on the founder. Now, obviously, the founder did a very, very bad thing, and I think it's right that she be held accountable. But it's odd that there is no accountability whatsoever for the investors. Like, shouldn't they have to pay some of the damages? Like, is that unreasonable? Am I being crazy here, Mr. Henrichs?
Well, I mean, that one would be interesting. I'd love to see the board decks. And
me too.
I'm wondering, were they pumping those same numbers to others, right? Like, we have other examples of this, like Solid, which just went bankrupt, right? They were sued by one of their investors because fake numbers, right? The desire to show that you're winning and everything goes up and to the right and CAC, plummets to close to zero. Everyone likes to pump those. So I wonder if she wasn't, though, telling her board the same thing.
It's a great question, right? And I think like there's a question of, and this goes to your larger point about people investing in this stuff or people building in this space without having any idea what they're doing or knowledge of how this market works. I mean, how much do we want to hold investors accountable for common sense, right? Like, say that the founder of that company was giving bad information to her investors or her board members. At a certain point, you have to sort of be like, you know what, that doesn't sound quite right, or that doesn't quite pass the smell test. Like, if you're selling your company to JPMorgan Chase for an amount that just doesn't make sense, like, don't you have some responsibility as a board member to be like, hang on, like, why are they buying us for this amount? Like, I doubt that was a pushback that the board gave, even though it logically probably didn't make sense if they had access to the real numbers.
Yeah, if they had access to the real numbers, I think it would raise some eyebrows. But, too often, and this was many years ago, a company that we eventually did successfully exit when I was a traditional VC versus, what we do with our corporate venture capital fund now. But, I was an early stage investor, and there was a Series C investor that was actually trying to wash me out. And the Series B lead investor had made the comment to me and said, partners at this firm would eat their own children if it was generated a good return for LPs. Yeah. And I think that is one of the problems here, is that incentive structure is just so wrong.
I could not agree more. I mean, it just feels like the the entire structure of this, and this kind of goes to your larger point about certain fields just not being a good fit, right? Like this model works better in other areas. It's a little not nice. It's a little aggressive. It's not kind of my cup of tea personally in terms of how I want to do business, but like, the old regulatory arbitrage playbook, like with Uber, like that worked, right? Like there's a reason why investors in Uber sort of came away from that experience going, yeah, you can just ignore regulation until you get big enough, and then you can force the regulations to adapt to you. Like this model works in other places. In fact, I would hazard a guess to say it actually probably works in most other fields. It just doesn't work in financial services. It probably doesn't work in healthcare, right? There are certain areas where the regulations don't bend as easily as they do in other places. And that's because the regulations are there for core safety and soundness and consumer protection reasons that are critical to like the survival of people in our society in a way that other industries, they just don't work that way. And so I do wonder if we need a more thoughtfully designed model for financial services specifically that takes some of these things into consideration. And it's interesting, I spend a lot of time talking to regulators as well. I know you do even more than I do. And it is fascinating to me because when I talk to regulators, they're sort of curious about venture capital and they will ask me questions about it, but they don't really have a great operating knowledge of how it works and what the dynamics are. And even more importantly, they really don't view venture capital in any way as fitting under their purview as regulators in financial services, because I think traditionally they're used to banks, or if they're dealing with non-banks, the non-banks they're dealing with are not historically subject to these sort of like VC specific incentive structures. It's really only in the last, 20, 30 years where venture capital as a business model really infiltrated financial services. And I do wonder if regulators need to think more from a first principles perspective about not only how to regulate fintech companies, but how to regulate fintech companies in a way that modulates some of the bad outcomes that come from this being a predominantly VC-backed business these days. Does that make sense?
Yeah, I think it needs to start at the board level, right? So bank boards need to get training on BSA, AML, and other risk and compliance factors.
And this is required by regulation, right?
Required by regulation. And if you look at all of the consent orders, maybe not all, but most of them, BSA AML like lights up like a big red beacon, and every single one of those is one of the places that these banks were deficient. You should apply that same level of scrutiny, like and in the consent order, it will say you need better board training and reporting. Those same things should be applied to the fintechs. In fact, if I was a BAS bank, that is what I would push on all of those, is that I want to see what your reporting is to your board. And I want to know that they've been trained on this, because I think there are way too many laissez-faire attitude towards AML and BSA, right? Like it impedes your speed of transactions and growth if you're in the payments business. But it's really serious stuff. And, in some recent reporting, when, it came out that one of the big fintech unicorns has hundreds, if not thousands, of business customers that use their registered agent as their physical address. And it's easy to throw up your arms and go, who knew? Well, actually, most banks knew. Like, you can't do that. Like, that is not actually knowing your customer.
Well, and most banks' boards knew that, right? Like this is a really interesting hypothetical question, but like imagine if you created a test to test the knowledge of financial services regulation, and you gave that test to the boards of every bank and to the boards of every consumer-facing fintech company. Which group would score higher on that test? Like, it's not even a competition, right? And obviously not all bank boards are perfect, as all of these consent orders have demonstrated, but like on average, the level of knowledge about the rules in the industry you're building in has to be orders of magnitude higher for bank boards than for fintech boards. I think that is a very, very logical requirement. I don't think that's unreasonable at all.
Yeah. And I think they should be held to account when the bad things happen, right? If you want to be adding a lot more customers by being fast and loose with KYC and KYB, great. There's a consequence attached to that. I
Yeah,
still
and you don't
remember.
just get to throw the founder who you push to do those things under the bus and go, it was him, not us. We have nothing to do with it. Like, that doesn't work.
Yeah, you cannot push all of the risk to the founder. You need to be held to account as well.
Yeah. No, I think that is exactly right. All right. I love that rant. That was a great one. Kind of building off of our last podcast together. Can I uncork a rant on you?
Yes, please.
All right. So mine is what I'm sort of thinking of as when first principles go wrong, AKA stop using neutral financial services infrastructure to achieve subjective policy goals. So I have written about this recently in relation to the credit bureaus, which is a group of companies I know pretty well. The thing that's interesting about the credit bureaus is they're really big. And because they're big and oligopolistic and are constantly screwing stuff up, they are very unpopular. No one likes them, right? Consumers don't like them. Consumer advocacy groups don't like them. Regulators don't like them. Politicians don't like them. So no one, left, right, center, really wants to step up and defend them or to believe them when they raise an objection about something that is maybe happening in the credit reporting space that they don't like or that they think might be bad. What ends up happening as a result of that is that we do a bunch of stuff to the credit files that we probably shouldn't, and that the credit bureaus probably know is not the right thing to do, right? And there's lots of examples of this. When we were going through the pandemic, there were a whole bunch of interventions that were done to protect student loan borrowers from defaulting. Some of those made sense in the early days, but like later on, in the later stages of the pandemic, we were even like resetting people's credit scores by wiping away defaults or delinquencies, or pausing the reporting of defaults or delinquencies, even though the repayments on federal student loans had resumed, right? Just essentially kind of monkeying around with furnishing data to the credit bureaus in order to achieve a different outcome, which was, hey, we should try to help people improve their scores. We should give them like a fresh start and an opportunity to like reset their credit worthiness. That's just not how credit reporting or credit scores or credit worthiness works, right? You can't just magically like go in and just erase things. The discussion around medical debt is another really interesting example.
I was just going to ask you that question.
Yeah, I mean,
yes or no? Should medical debt be included in your credit report?
I actually think that it should, and we should just have much, much, much higher standards for how that data is reported and the accuracy of it. Because a lot of the objections that come around medical reporting have more to do with like, oh, these collection shops are using it as a carrot, but not a stick. They'll only furnish negative data. Well, we should fix that. Oh, they won't update something even when it's already been paid because there's no incentive for them to do that. So a lot of it is more relating to accuracy and fairness about how the data is furnished. I would be in favor of maybe reducing some of the ones that you list. Like there could be thresholds under which or over which you don't report it. I think I could see that. But like some level of this data is actually useful for making a credit decision. And I think done well, it could sort of pass the sniff test in terms of being fair. But because we just don't like the outcome that this has, we just say, nope, this isn't going to be put in the credit bureaus at all. We're just going to get rid of it. Or the converse example of this is BNPL, right? BNPL companies should absolutely be reporting their data to the credit bureaus. They don't want to, which is very logical. But the thing that drives me crazy is when you talk to consumer advocates and you're like, hey, the BNPL companies should furnish their data to the bureaus. They're like, well, yeah, but if they did, it would cause people's scores to go down. And that's bad. And it's like, no, that's accurate, right? Like we want lenders to have data to make decisions. And again, this goes back to my core point. The credit bureau should be treated as neutral infrastructure for making the best possible credit decisions. We shouldn't impose any of our values on top of it. And when we do, what ends up happening is the credit bureaus are treated as this sort of instrument of social change. And the result is, and this is exactly what's happening with BNPL and with credit builder products and with all the changes that were made around how student loan data was reported, lenders just stop trusting the credit bureaus. They just stop trusting the credit data. And the result of that is that they shrink their credit boxes because lenders aren't idiots. They just lend money less, which is actually contrary to the goal that we all have. So This is the cost of monkeying around with financial services infrastructure. And the problem is that this is not just something that happens with sort of left-leaning sort of consumer advocacy groups. And those were the ones I was just giving examples of, oh, hey, it's unfair. It has a negative impact on certain underserved groups. Therefore, we shouldn't do it. Again, sympathetic to these arguments, but that tends to be historically where a lot of this has come from. Now, if we fast forward to today, under the Trump administration, we're actually seeing a ton of examples of this same thing happening. Mr. Henrichs, I'm not sure if you saw the article about the Social Security Administration having their death master file updated to include the living names of immigrants with temporary legal status in the U.S. being added to the Social Security Administration's master death file. Did you see this?
Yes. I mean, you're literally killing the person's financial life.
That's exactly what you're doing, because in addition to the Social Security Administration maintaining this death file, the Commerce Department sells a version of this list to banks and credit bureaus and other financial institutions to help them avoid opening accounts with scammers who will often use the SSNs of deceased individuals to open accounts. So literally, according to the New York Times, the intent behind this was to cut off these immigrants with legal status in the U.S. to be here from having access to financial services so that they will voluntarily deport from the U.S. Now, again, if you want to pass different laws, if you want to make changes to the laws we have around immigration, that's totally fine, right? That's a different kind of kettle of fish, and that has nothing to do with what we're talking about. The problem is you can't use neutral infrastructure that just needs to work for everyone to achieve these goals. Because now, again, what's going to happen is these banks and these credit bureaus, they're not going to trust the death master file from the Social Security Administration because the data isn't right? Like the data is wrong. As soon as you start monkeying around with the data, we have a problem. And as a result of that, what's going to happen is that it's actually going to become easier for scammers to use deceased people's Social Security numbers to open up accounts and to steal money because we've made this data source unreliable, right? So again, this is the cost of doing this. There's one more example I want to give, which is a little different, but is in some ways kind of the scariest example. This is the effort by the Department of Government Efficiency and Elon Musk to essentially rein in what they call sort of fraudulent payments, right? So there was this example, and this was Nathan Tankus and Rolling Stone wrote about this, where the FEMA basically clawed back $80 million from New York City, the city of New York, their main bank account held at Citibank, in order to rescind funding that had been appropriated by Congress to help the city of New York house refugees, right? And the allegation was that this was clawed back because there was fraud and illegal activity relating to the money that was being used to house these refugees. Again, setting the allegations there aside, and I haven't seen any evidence that that's true, but setting those allegations aside, it's the mechanics of how this clawback happened, right? Because New York City's Citibank account actually went negative by like $79.5 million, which
but they waived the overdraft fee.
Yeah, right. Citibank kindly agreed to waive the overdraft fee. The city covered it with a line of credit, but like literally their account went negative because the government clawed this back. Well, how did they do that? Well, the way they did that was not through some like legal channel, right? There are legal ways to claw back money if you want to allege fraud, but it has to go through legal channels to be approved before that happens. They didn't do that. They just went to the Bureau of Fiscal Service, which is the Treasury Department that essentially manages the government's bank account and facilitates all of the money coming in and out of that bank account, to approve the debiting of this transaction for this government payment. So like literally they used, again, neutral government infrastructure that is not supposed to in any way be political to essentially undermine the idea of payment finality, which is an incredibly important sort of baseline concept for trusting our ACH system, that when you get money sent to you, it can't just randomly be clawed back because someone cries foul. That is a bedrock principle of how our payment system works. not so much anymore. And so again, like none of this is how this is supposed to work. And it goes to your core point about trust. You have to trust the credit file. You have to trust the Social Security Administration's death list. You have to trust the Treasury Department and the Federal Reserve and how they run the ACH system. You have to trust these pieces of infrastructure in order for everything we want to work well. And when you undermine that trust by monkeying around with those systems, you are causing a problem that I don't think you really realize you are, and it's going to take a long time to fix.
Absolutely. Now, one thing I want to pull on is I disagree on the medical debt. And the reason for this
that's totally fair.
Is,
that's totally fair. Right? That's an edge one that I'm willing to argue about.
Right. Because what is your credit score supposed to show? Your willingness to pay and your ability to pay, right? Yep. And I would argue somebody who has, I don't know, the last major medical event, I'm going to guess birth of one of your children, right? Yeah. You saw the bill that came from this. Right? Oh, yeah. Imagine if you didn't have good insurance. Right. Mm-hmm. Or worse, it's a heart attack. These things that you did not choose.
You didn't control,
to incur the debt for, right? Not
and
in
it's
your
massively
control.
Expensive. Yep.
Sure. And that, like, if it were cheaper, right, mm-hmm. or it was like cosmetic medical debt, right? Okay, you You chose to have your teeth fixed or your nose whitened, right.
That's 100% right. No, I hear nose whitened. Yeah, no, I think that's right. I mean, I think that's kind of how I feel. I think you and I are actually closer to the same page on this, where it's like there's probably a version of medical debt that's elective that probably should give you a window into, because it's, are you taking on an expense that you don't need to take on, that maybe you can't pay for, that going in your insurance isn't going to cover. There's a version of this that makes sense as a reflection of your ability and willingness to pay. But to your point, and this is where a lot of, I totally sympathize with consumer advocates, there's a lot of medical debt that is completely outside of your control, act of God, has really no bearing on your ability or willingness to pay. So I agree with you. I'm on the fence on that one, but it is an interesting example of this larger sort of discussion.
But back to your trust, right? If I can't trust the score because of lots of these other things, and let's face it, the bureaus do themselves no kind of goodwill when they themselves offer credit builder things that you pay for.
They do themselves no favor. They do themselves no favor on not vetting the companies that are furnishing data to them. They do no favors when they have massive data breaches that get everyone's data. Like the credit bureaus are not a good actor in this, I will say. And I think that applies to government agencies as well, right? Like this is in no way meant for me to defend the way that we've been running all of these systems, but like, you have to still trust these systems and treat them with a certain amount of sanctity, I guess is the point.
Yeah. And the unintended consequence, right, is you shrink the credit box because I can't trust the data. What happens to those people? They don't just leave the system. They find money elsewhere. And this is the problem. They end up going to one of these non-bank lenders or a payday lender that is charging a much higher rates that they maybe don't have the ability to repay. And they end up in this vicious cycle of they can barely cover the interest, or maybe it pushes them down further. Well, guess what? Now their credit score goes down even further. So they're even more dependent on going outside of the system. So I haven't created greater access. I've actually made it worse, and I've pushed them to the bad actors.
Yep, that is exactly right. And I think that the same thing will apply to some of the other examples I gave about like the Social Security Administration's master death list, right? Like, I mean, like that, the purpose of sharing that with banks and with the credit bureaus is to keep scammers out of financial services. If you don't keep scammers out of financial services, that ripples through the system in a whole bunch of ways that are bad for all of the consumers we're trying to help, right? Like, it makes banks less willing to approve transactions or to make things seamless for consumers because they're scammers and they just can't take the risk. It makes consumers less willing to trust these systems because there might be a scammer on the other end trying to get my money. Like when scammers are inside the financial services perimeter, everyone trusts things less and there's more friction and more cost than we want there to be. And there's no reason that we have to be doing this except that we're trying to achieve some other goal by monkeying around with this list and literally listing people on this list who are alive and saying that they're dead. That's crazy.
Yeah. Yeah. And I think part of the challenge here is we're by weaponizing these agencies, right, and using them in a ploy. It it destabilizes everything, right? We have rules and compliance for a reason to act as guardrails, right? And I think one of the ways we got off on the wrong foot with this was even the original creation of the CFPB. Now, I think the CFPB has done a ton of good, but from the outset also pursued political aims in how it went after some things, right?
Totally agree.
And so, surprise, pendulum swings way too far back the other direction.
Yeah.
And now we find ourselves, again, unintended consequences.
I completely agree. The last point I'll make on this one, and then we'll take a quick break, is I really feel like this ties right back to your story about the incentives that we give people who build, right? And sort of how compatible that is with financial services. Elon Musk is the one driving a lot of this stuff under the Trump administration in terms of finding creative ways to use these different systems. And if you sort of squint and take the politics out of it for a second, it actually is very similar to the way that he's built other companies or that, founders build, right? Like they just look for first principles ways of achieving their aim. Like, oh, hey, there's a system over there that we could use as a choke point to do this thing. Or the right way to solve this problem is to just change the way that we're adding data to this place. Like he looks at it just from like a systems architecture perspective and finds the most obvious places to implement what he wants to see happen. Now, again, I don't in any way agree with the things he's trying to make happen, but I think we have to sort of separate that concern from the other concern, which is we don't do that in financial services. The infrastructure that we have needs to kind of remain inviolate. You can't screw with it just to achieve your goal because you are undermining the trust that is built into that system and the trust people have that will always work a certain way, regardless of who is in power at that moment. So I very much agree. The pendulum is going to swing back. Quite frankly, I hope when the pendulum does swing back, we see a resurgence in people who want to sort of strengthen and protect this infrastructure rather than using it to pursue whatever their aims are at the time. I'm not super confident that will be the case, Mr. Henrichs, but we will see. All right.
When we come back, I want to talk about Doge. That's going to be the next rant.
Hey, okay. That's a good tease. All right. Do you need more? More time? More revenue? More growth? Software companies are born global, but the complexity of selling worldwide can be overwhelming. Managing payments, sales tax, fraud, refunds, they slow you down, but getting them right is essential. That's why over 5,000 digital businesses choose Paddle as their merchant of record, or MOR. More. Complete sales tax compliance globally, multi-currency payments, fraud protection, billing support, all taken care of. With Paddle's MOR model, you get more. More time, more revenue, more growth. Learn more at paddle.com. Okay, we are back, and Mr. Henrichs, I think we have time for each of us to do one more rant and sort of get something off of our shoulders. I feel like you and I are probably going to be digging in similar areas, but I'm going to let you go first.
Well, I want to talk about key in my favorite topic, compliance, right? And so the effort under Doge was, if you read the Wall Street Journal headlines, which a lot of bank boards do, we've entered a new era where there is going to be less regulatory pressure on our financial institutions. We are going to let innovation reign, and banks can play in crypto and stable coins and all of this. That's what bank boards are hearing. And at acquire, be acquired, like the attitude was almost euphoric on, hey, this is going to open up M&A and all of these things. Let me tell you the harsh reality of our member banks and what they're going through right now. The memo didn't get passed down to the front line. Those people are still coming in. In fact, most of our banks are saying these are some of the worst exams they've had yet, because the most experienced people, the ones that could actually give opinions on history of this innovative thing, how does this work? Should this merger be approved? They're gone, right? Like the people you need, the expertise, it's out. So everyone else is understaffed, scrambling, trying to CYA themselves by asking as many questions as possible because they don't have the people who have the judgment anymore. And I had breakfast with a banker this morning, and I was describing, and she's a brilliant banker, chief strategy officer, a very successful bank, said this, and she just like had this soul coming out sigh of just like, that is exactly what's happening right now. And she's like, we're not even trying to do things that are really outside, like pushing the limits here. It's not crypto. It's not anything to do with banking as a service or fintech partnerships. She's like, it's impacting our mainline business, which is commercial real estate, right? Like it's things we've done since the bank was founded in 2005 now is under this intense scrutiny, as if like, if it was going to go wrong, it would have over the previous 20 years, right? We're not dramatically changing things up. But again, unintended consequences, when you just rip out and willy-nilly remove regulators, it becomes this, oh no, what do I do, right? Like, let's use CFPB as another example, right?
Sure.
I think they need to be rechartered and rethought how, that was being run in the mission. Although I'd say the overall mission was pure, how it was being implemented was not.
Yeah.
But the discussion our banks are having is, okay, so what happens in 4 years? If you're not under the pressure now, but what happens 4 years from now when they, presumably the CFPB is active again, and they come back and they go, oh, Alex, that lending you've been doing, that's a problem. And I think that's part of how we ended up here in the first place with like the Evolve situation and these consent orders, right? Because some of these consent orders should never have gone all the way to become a consent order, right?
Oh,
like
totally.
they should have been discussions, maybe end up in a memo, in corrections. But the problem was when Trump was in the first time and the CFPB was effectively neutered, and Yelena was working on how do we modernize the FDIC, and that was interpreted as hands off, right? On the front lines, they didn't know what to do, and it's hard to change that organization, but she was doing a great job of beginning to navigate it. But things that should have been minor course corrections early on, right? Like, hey, you can't use bank in your name. Like, not a bit. I understand you didn't know that. If you're playing in financial services, you probably should have known that, but like, just take it off, right?
Yeah.
And hey, bank that's monitoring these things, like you can't be using your registered agent address, right? Like if you have hundreds, if not thousands of customers at the same address, you probably need better systems, right? Like, go work on that and let's have a discussion. But when we ended up in this era of hands off, these minor things became major things. And let's face it, once you're in the Wild West, it gets wilder and wilder. No one kind of voluntarily comes back and is like, you know what, VCs, we should probably, now that, we've got all of these customers, do more compliance stuff. No, that's not the board discussion. It's like, what happens if I give you $300 million more dollars? Right?
Double down, right?
Double down. Keep moving fast. BSA, AML, as long as the transaction's clear, we're good.
Yep.
What is an OFAC sanctioned country anyway? So this kind of minor course correction now became a very adversarial when we're trying to put the genie back in the box, right? So you had some banks playing in spaces they shouldn't have been. The power was all on the startup because that's where the money was and everyone wanted in. So you're competing by being faster and looser on the compliance. And then you have now the resurgence of the regulator coming in. And rather than taking the stance of, hey, we need to do some course corrections, it's become very adversarial.
Yeah, I mean, it's a really, really great observation, and I'm glad you shared that with me because you spend a lot more time talking to banks, going through exams than I do. But I guess it's a unintended consequence is a great way of putting it, right? We want to deregulate, like we want to open it up and make it easier for banks to innovate, to pursue crypto, to pursue all of these things. Like it's not going to be like the last 4 years. Okay, great. Well, the challenge is that you are not changing the fundamental nature or job of prudential bank regulators, right? Like, I think that's the most important thing is, and you have to think about this as like humans working in a job. The humans working in this job, their job is to make sure that the financial services industry does not melt down to the ground, right? Like that is their job. It is safety and soundness. And they are going to pursue an objective of safety and soundness above everything else. You can tell the OCC or the FDIC or the Fed or any of the state regulators, hey, like, we want to pursue innovation. We want to like take more risks. Fine. You can tell them that. But at the end of the day, that's not what they get paid for. They get paid to make sure that banks don't fail. And when they do fail, they are resolved in a orderly and quick manner. So what you do if you really want to achieve deregulation and have, banks innovating more and taking more risks is you give that mandate to experienced regulators who have been around, who can sort of treat these subjects with nuance because they understand them, right? And I think that's such a good point and something that is not appreciated in financial services or fintech at all. Experience actually allows you to take risks safely because this, I know this is like banking as a service and it's done this way, but if you were around during the prepaid era, you might have seen something that is structurally very similar to banking as a service. And here were the things that worked well then, and here were the things that were actually really bad. And those are like, that's a hot stove. You don't want to touch it, even though the stove looks a little different now than it did before. Still a hot stove. Don't touch it. But to your point, if you drive all of those people to take offers to retire, or you just fire them, or you create an environment where it's clear their expertise is not welcome, what's going to happen? Well, they're not going to get replaced by people who have different incentives, right? Because everyone who works at these agencies, they still need to do CYA. They still need to make sure that, their agency isn't ending up on the cover of the Wall Street Journal going, what the hell was this agency thinking, allowing this bank to do these things? They can't let that happen. But they are not going to color in the picture with the same type of nuance that an experienced regulator will. They'll just go, well, if you're going to do this thing, I have to ask you all these questions. And you're giving me a nuanced answer, but I don't really know enough to parse that nuanced answer. So our response is, no, that's too risky. So it actually doesn't surprise me, even though it does seem a little counterintuitive, that banks have been having a harder time with less experienced regulators trying to do the things that this administration is encouraging them to do.
Yes, absolutely. And
the
danger becomes, right, is those banks become less innovative, less, customer-centric in the services they provide. Now we're pushing more and more of this out of the system into those who might not understand consumer protection or the importance of stability, right? And so we're back to where we started. We're actively working against our own aims.
That is 100% true. The other thing I want to ask you about on this one, Mr. Henrichs, is how do you think fintech companies and non-banks that are pursuing charters are going to feel once they go into some of these exams? Because I think that those companies were sort of maybe misreading the situation the same way that banks were, where they're going, hey, deregulation, the ability to go get a bank charter or whatever is like open. We're open for business. We're going to go do these things. We've already seen a number of fintech companies pursue different types of charters in the last couple of months. I would guess that they're going to be sort of getting the same rude awakening that banks have been getting, where, okay, we got the charter, we got conditional approval, we're going through this process, we're going into our first exam. And instead of getting the experienced regulator that can sort of help them navigate, here's how you be a bank, but we're open to these ideas. We know you're a little different in how you do things. They're getting those inexperienced regulators who don't know the difference between these things. I would think this is just as bad for fintech companies that are kind of moving into becoming banks, which is a huge strategic priority for a lot of them, as it is for banks.
Yep. I actually think this is, let's look at Stripe and like their limited use charter as an example. Yeah. They brought in tons of experienced people. They're doing it the right way, right? They are taking compliance very seriously. Mm-hmm. And I think they're taking advantage of the window of time that they could actually do this because the pressure is on to loosen up and appear more innovative. And once you get the charter, right, I think in some cases they might be the ones teaching the regulators how to regulate them.
I think
with the
true.
level of experience and the people that they've been hiring to go do this. And I think that ultimately is a good thing. Mm-hmm. And it's going to be this transition period, though, in the vacillations. Go back to, I think everyone except, high frequency traders crave certainty. We're in very uncertain waters right now, and no one craves certainty more than a banker does.
That is 100% true. And it's actually the perfect lead into my rant. Can I just build on yours? Okay. So mine is, the title of my second rant is A Different Form of Uncertainty. So building on your exact point, I think that the lesson from the last couple of weeks, in a non-banking context, in a general Econ 101 context, is uncertainty is very expensive, right? So obviously, I think every economist sort of knew and loudly said tariffs are a bad idea. They're a bad economic policy. But even as we've sort of vacillated back and forth on tariffs and the amount of tariffs and reciprocal tariffs and all these questions, the real issue I've noticed is that the market continues to be hurt by the uncertainty with which the Trump administration is implementing tariffs, right? So it's not so much the tariffs, even though those are not great. It's the uncertainty of, are we doing it? Are we not? Do our products have an exemption? Do they not? It seems to change day to day. If I pay $1 million to go have dinner at Mar-a-Lago, maybe I can get my products exempted, but maybe then they'll change their minds. Companies don't know what their costs are going to be. And that makes strategic planning, including investment decisions, really hard, which then has sort of longer term economic consequences, even if you sort of back away from the idea of tariffs the way that they were originally announced. So applying that idea or that mindset, I am seeing, and it builds on exactly what you were saying, that same uncertainty pop up in financial services regulation as the Trump administration has attempted to enact its deregulatory agenda. So you talked about sort of lack of experience and the sort of uncertainty and sort of less appreciation for nuance that introduces into regulatory agencies. I also think the other thing we're seeing is this sort of slapdash approach to deregulation that also actually creates a lot of uncertainty. So a couple examples. One is the CFPB announcing late last month that it will, quote, not prioritize enforcement or supervision actions with regard to any penalties or fines associated with the payment withdrawal provisions and the payment disclosure provisions of the CFPB's payday lending rule, right? So this long-standing rule that's been going through a lot of judicial legal challenges, finally, part of it is being implemented. And the CFPB basically came out and said, yeah, we're just not going to enforce or do any supervision in regards to that. So essentially, feel free to ignore it. And they just put that out in the form of a very short blog post. That is a very weird thing to do because they are not initiating rulemaking to modify or repeal the rule. They're just announcing via blog post that they're not going to enforce it. Another example, Evan Weinberger, our friend at Bloomberg Law, he reported that the Federal Housing Finance Agency, the FHFA director, Bill Pulte, who was just appointed recently, has announced a bunch of changes to Biden-era FHFA programs that were designed to boost home ownership for Black, Latino, and other minority communities. Not shocking that they are sort of reversing course on this if you've been paying attention to the Trump administration's approach to what they would call DEI. But again, the thing that's weird here is he's announcing all of these changes via Twitter with no formal process or chance for public input. He's literally just going on Twitter and saying, yeah, we're not doing this anymore. And according to Evan's reporting, this has introduced a lot of like confusion and uncertainty for bank and non-bank mortgage lenders who are like, okay, are we still doing this? Are we not? I'm a little bit confused. And then the third example, which is a little bit outside of financial services, but is very, very relevant to financial services, were a couple of executive orders that were recently announced, focused on deregulation. One of them was on the very important deregulatory subject of showerhead regulation. Apparently, this is a first 100 days priority, and it included this line. Notice and comment is unnecessary because I, meaning President Trump, am ordering the repeal. A different executive order that was released around the same time instructed government agencies to evaluate whether current regulations are in line with recent Supreme Court rulings, including Loper-Bright, and could be easily repealed. And essentially what that EO is saying is it is instructing the agencies to retroactively consider regulations where agencies took significant latitude in their rulemaking to be unlawful and to repeal them. And again, to do so without any public notice of the repeal or seeking public comment. Essentially, they're just saying, hey, repeal these things and you don't have to like go through the normal administrative process for getting public comment. These directives are, to put it very mildly, very legally dubious and likely to challenge. So here's the part that's strange to me about all of this. This is not... the problem is not deregulation, right? Like, we knew deregulation was coming. As you said, all the banks that were at AOBA were just like ecstatic about the chance for deregulation. Like, we knew this was coming. And honestly, even from my perspective, I kind of welcomed it, at least in certain quarters, right? Like, I think a little sort of bouncing back and forth between regulation, a little deregulation, like, I think that actually can be healthy for the ecosystem to a degree. The problem, and this is what bank and fintech executives, I think, would tell you now, is the uncertainty that is being introduced with how the administration is pursuing deregulation, right? So simply saying you're not going to enforce payday lending rule doesn't mean the rule is not enforced. It is. And it doesn't prevent state attorneys generals from going after payday lenders who violate that rule or violate consumer protection rules. Nor does it protect companies that violate this rule when there's a new CFPB 4 years from now that maybe doesn't have the same approach to not enforcing this rule. Reversing prior guidance, policies, or rules on equitable housing via Twitter introduces a lot of uncertainty, right? If I was a bank pursuing this, some of these sort of initiatives to increase housing affordability and availability for some of these underserved groups, I've actually spoken to a lot of banks that are pursuing those programs. And what they will tell you is this is actually good business for us. Like, we are making money, we are making loans that are profitable. But now you have to wonder, especially because these things are being announced so proudly on Twitter without a lot of, kind of consideration. Is the Trump administration going to retaliate against me if I continue to participate in these lending programs just by saying we're not doing this anymore? Does that mean that de facto these activities are frowned upon? Like, it's not a crazy question to ask. And I've spoken to bankers who are involved in these programs who are like, yeah, I think we're going to keep doing it, but we're going to do it really quietly so that we don't like raise the ire of the administration. Like, that uncertainty is bad. Repealing rules that you don't like based on unsound legal theory that is guaranteed to be challenged in the courts doesn't help companies you are trying to help, because they are not, if they're smart and have good lawyers, going to act on those repeals until the courts weigh in, right? So I guess the point of all of this, go.
Bad actors. Bad actors. Right. Now you've opened the door and made it easier for the bad actors, or those that don't think through and understand the compliance and risk issues.
That is exactly right. So deregulation plus uncertainty is only deregulation for bad actors, is kind of the headline of all of this. And that I don't know, Jason, that seems bad to me.
Yeah, what could possibly go wrong? Yeah, let them run faster and looser.
Well, I mean, and just like it goes back to your earlier point about, and let's just constrain the good actors who want to responsibly pursue innovation from even considering pursuing responsible innovation. Because, like, again, much like, a manufacturer in the US going, I think I'm just going to have to cancel that contract because I just literally don't know what my costs are going to be next week. Like, the uncertainty paralyzes the exact companies and the exact actors in the system that you are trying to unleash and enable and allow to innovate.
Yeah, well, and, who's going to be hurt in a lot of this uncertainty around tariffs are the Main Street small businesses.
That's right.
And Main Street small businesses are the major employers and the major engine of our GDP. Mm-hmm. And so now we're talking about jobs being lost, which create, it's a vicious cycle of what this uncertainty is unleashing.
And I think it applies to your point about small businesses, it applies to community banks, right? Like, if I'm a community bank and I just have no idea what I'm allowed to do and what I'm not allowed to do. I mean, you and I have talked about this. Community banks cannot sit still, right? Like, community banks have to move fast. They have to be aggressive. They have to pursue customer value and innovation focused on customer value aggressively if they want to survive, right? Like, Chase can sit on its ass and not do anything and survive. They're fine. But if you're a community bank, you have to aggressively put the chips down that you have and bet on a future that you can bring to life. Yep. You're now less willing to make those bets or to take aggressive action because of all of this uncertainty, I would think.
And they become more expensive bets, right? If I don't have the certainty, if I can't get some regulatory guidance on where it's going, or it's going to dry out my exam by another 2 weeks, or I'm waiting on feedback from regulators. The cost of doing that business has just gone up.
It absolutely is. I mean, I'm cautiously optimistic that the folks who've been appointed to head the federal agencies, specifically overseeing banks, are pretty sober, cautious, sort of inside the beltway sort of individuals. And so I'm cautiously optimistic that they will insulate some of this uncertainty away from the market a bit, but it's hard to bet on that over the next 4 years. I mean, I would say we're going to get a pretty uncertain regulatory environment relative to the one that I think banks and fintech companies thought they were signing up for over the next 4 years.
This is not what they thought they were signing up for.
Which is problematic for everyone. All right. Jason, first of all, that was really fun. Second of all, we managed to come in well under the time limit that Kiah and I usually set for ourselves. So that's quite an accomplishment for Bank Nerd Corner. You can hang your hat on that, even though you and I think, we're much less prepared than Kiah normally is. But this was a lot of fun. Hopefully you can come back and do this again.
Well, next time I will prepare my dissertation and I will be ready Kiah style with esoteric regulations and comment about call reports.
All right. I will hold you to that, sir. But until then, be well and thanks for joining us.